There is a name, 2 words, that has come to mean something far larger than the street it refers to. You could walk the actual street in under 10 minutes. But the name Wall Street has reached into every corner of the world, into pension funds and mortgages, and into the pockets of people who have never been within 1,000 miles of Lower Manhattan. And yet, in the last 160 years, more money has been stolen on that street than in every bank robbery in human history combined. One man on that street ran a fraud so large it reached $64 billion. And the people whose job it was to stop him, they were told, repeatedly, for 5 years, with mathematical proof, they did nothing. One woman convinced Henry Kissinger, 2 former secretaries of defense, and Rupert Murdoch to invest hundreds of millions in technology that never existed. And nobody checked, because nobody wanted to. A 28-year-old trader in Singapore destroyed the oldest bank in Britain. A bank that had financed the Napoleonic Wars, funded the Louisiana Purchase, and managed the personal accounts of Queen Elizabeth II. He brought it all down, left a note on his desk that read, simply, "I'm sorry." The bank was sold for £1. This is not a story about a few bad apples. This is the entire criminal history of Wall Street. Singapore, February 23rd, 1995. It's early morning. The trading floor of the Singapore International Monetary Exchange is still quiet. Most of the brokers haven't arrived yet. But in a small office on the upper floor, a 28-year-old Englishman is sitting at his desk, staring at a number on his screen. £827 million. That's the loss, not the profit. The loss. And it belongs to him. Well, it belongs to his employer. Barings Bank, the oldest merchant bank in Britain. Founded in 1762. 233 years of history. The bank that financed the Napoleonic Wars, the bank that funded the Louisiana Purchase, the bank that managed the personal finances of Her Majesty, Queen Elizabeth II. And now, because of this one man's trades, it is insolvent. He pulls a piece of paper toward him, writes 2 words, "I'm sorry," leaves it on the desk, walks out of the office, gets in a taxi to the airport, and disappears. Within 72 hours, Barings Bank, the institution that had survived 2 world wars, the Great Depression, and every financial crisis of the 20th century, would be declared bankrupt and sold to a Dutch banking group for £1 sterling. 1 single pound. The man's name was Nick Leeson. He was 28 years old. He came from a working-class family in Watford, England. He'd never been to university, and he had just destroyed a 233-year-old institution that even Napoleon couldn't bring down. How? We'll come back to that, I promise. But first, you need to understand something. What happened in Singapore in 1995 was not an anomaly. It was not a one-off. It was the latest chapter in a criminal history that stretches back more than a century, to a time when Wall Street wasn't just unregulated, it was designed to be cheated. If these stories speak to you, if you find comfort in the lessons found in the quiet corners of history, tap the subscribe button to join our circle of dreamers and let the next story find you when you need it most. Welcome, Midnight Magnates. This is Mr. Calder. As the world goes quiet, we step into the shadows to uncover the stories that built our world. If you enjoy listening or falling asleep to the hidden history of power, fortunes made, and the human nature behind the price of greatness, then this is the place for you. As we begin tonight, let me know in the comments where you are listening from and what time of day is it there. Morning, on a commute to work, or a very late night. Now, let's drift off. In 1869, the New York Times gave a man a nickname that would follow him to his grave. They called him the Mephistopheles of Wall Street. His name was Jay Gould, and while you might not know his name the way you know the names of modern financial criminals, you should. Because Jay Gould didn't just commit crimes on Wall Street. He wrote the playbook that every Wall Street criminal since has followed, whether they know it or not. Gould grew up poor. His father was a farmer in upstate New York. By the time he was 20, Gould had taught himself surveying, engineering, and the art of making money from other people's money. By his early 30s, he had clawed his way onto the board of the Erie Railroad, one of the most important companies in America. Now, here's what you need to understand about Wall Street in the 1860s. There was no Securities and Exchange Commission, no federal regulation of stock markets, no insider trading laws, no prohibition on market manipulation. The stock exchange was, in the most literal sense, the Wild West with better suits. And Gould, he exploited every inch of it. When Cornelius Vanderbilt, the richest man in America, tried to take control of the Erie Railroad, Gould fought back in a way nobody expected. He simply printed more stock. Fraudulent shares, millions of dollars worth of certificates that had no legal backing. When Vanderbilt's lawyers got a judge to issue an arrest warrant, Gould fled across the Hudson River to New Jersey with suitcases full of cash. And then he used that cash to bribe the New York State Legislature into retroactively legalizing the stock he'd printed. Let me say that again. He printed fake stock, got caught, bribed the government, and they made it legal after the fact. But the Erie Railroad War was just the appetizer. Because in 1869, Jay Gould and his partner James Fisk decided to do something that, even by the standards of the Gilded Age, was breathtakingly audacious. They tried to corner the entire United States gold market. The plan was elegant in its simplicity. Gould and Fisk began buying gold in enormous quantities, driving the price up and up and up. To prevent the government from intervening, because the U.S. Treasury could flood the market with gold and crash the price, Gould cultivated a relationship with President Ulysses Grant's brother-in-law, Abel Corbin. Through Corbin, Gould tried to convince the Grant administration to hold back its gold reserves. For a while it worked. The price of gold surged from around $130 to $163.50. Gould and Fisk were making millions. But on September 24th, 1869, a day that would become known as Black Friday, the Treasury finally intervened. They released $4 million in gold onto the market. The price collapsed in minutes. The panic that followed ruined thousands of investors. Businesses failed. Banks closed. The economy shuddered. And Jay Gould? He had quietly sold his gold positions before the crash. He walked away with his fortune intact. He was never meaningfully punished. When Gould died in 1892, his net worth worth was $77 million, roughly $2.5 billion in today's money. He left behind a legacy not of buildings or railroads, but of methods, stock manipulation, insider information, political corruption, using complexity to disguise theft. Every one of these techniques would be refined and repeated by Wall Street criminals for the next century and a half. But here's the thing about the era that followed Gould. His methods didn't die with him. They became standard practice, and by the 1920s, they had evolved into something even more brazen. They were called stock pools, and they were perfectly legal. Here's how they worked. A group of wealthy investors would secretly agree to buy large amounts of a particular stock. Their coordinated buying would drive the price up. Stock market commentators, some of whom were in on the scheme, would report on the stock's impressive performance. Regular Americans, seeing the rising price and the positive coverage, would pile in. And once enough outside money had inflated the price, the pool members would sell everything at once and pocket the difference. In March of 1929, a man named Michael Meehan organized one of the most successful pools in Wall Street history. The target was Radio Corporation of America, RCA. Over the course of 9 days, from March 8th to the 17th, Meehan and his partners pushed RCA's stock up nearly 50%. Then they sold. In 9 days, they had made the equivalent of $100 million in today's money, and they did it in broad daylight, because nobody could stop them. Meanwhile, a man named Charles Mitchell, the president of National City Bank, which would eventually become Citibank, was selling stocks and high-yield bonds directly to small, ordinary investors. He was one of the first to bring Wall Street to Main Street. He was celebrated for it. Newspapers called him the banker's banker. What they didn't know was that Mitchell was also involved in manipulating Anaconda copper stock. His bank sold 1.3 million shares at around $120 each. The stock would eventually fall to $5. The small investors who trusted Mitchell lost everything. And then there was Albert Wiggin, the president of Chase National Bank, the man who built Chase into one of the largest banks in the world, a pillar of the financial establishment. During the crash of 1929, while Wiggin was publicly reassuring investors that the market was sound, he was privately shorting his own bank's stock through a network of shell companies, betting against the institution he ran, making millions as his own shareholders lost their savings. And here's the part that makes your head spin. What Wiggin did was completely legal. In 1929, there was no law against shorting your own company's stock. No law against using inside information. No law against misleading your shareholders. Wiggin was never criminally prosecuted. He was forced to resign, but he kept his money. His actions, however, did lead to something important. A specific provision in the Securities Exchange Act of 1934, known as the Wiggin section, that finally made it illegal for corporate insiders to short their own company's stock. Now, I want you to sit with that for a moment. The man who manipulated stock pools, the man who shorted his own bank, the man who bribed legislators, none of them were criminals when they did what they did. The laws had to be written because of them. The Securities and Exchange Commission was created in 1934, specifically because Wall Street had proven, beyond any doubt, that it could not be trusted to regulate itself. And who did President Roosevelt choose to run this brand new agency? Who became the very first chairman of the SEC? Joseph Kennedy, a man who had made his fortune participating in stock pools. The fox didn't just guard the henhouse, he designed it. So, the SEC was born, laws were passed, regulations were written. The era of open, brazen market manipulation was supposed to be over. And for a while, it was quiet. For a few decades, Wall Street played by the new rules. Or at least, it appeared to. But beneath the surface, the old instincts were just waiting for the right moment, the right opportunity, the right excuse to resurface. That moment arrived in the 1980s, and when it did, Wall Street remembered exactly what it was. Now, remember that young man in Singapore, the one who wrote a two-word note and disappeared? Let's go back to the beginning of his story, because it's one of the most extraordinary tales in financial history. Not because of the size of the fraud, though it was enormous, but because of how one ordinary person, with no particular genius and no grand plan, managed to bring down an institution that had stood for more than 2 centuries. Nick Leeson grew up in Watford, a commuter town just north of London. His father was a plasterer. He didn't go to university. He got a job as a clerk at a bank, worked his way up, and in 1989, at the age of 22, he was hired by Barings Bank. Barings. The name alone carried weight. Founded in 1762, it was the oldest merchant bank in Britain. It had financed the British government during the Napoleonic Wars. It had helped fund the Louisiana Purchase. It had survived every financial crisis of the 19th and 20th centuries. And it managed the personal accounts of the royal family. This was not some fly-by-night operation. This was the Bank of England's bank. Leeson proved himself quickly. He was good with numbers, reliable, and, crucially, willing to work in places other traders didn't want to go. In 1992, Barings sent him to Singapore to manage the settlements office at the Singapore International Monetary Exchange. His job was supposed to be simple: execute arbitrage trades on Japanese stock index futures, exploiting tiny price differences between the Singapore and Osaka exchanges. Here's where the first crack appears. Barings gave Leeson control of both the trading desk and the back office, the settlements department that was supposed to verify and check the trades. In any properly run financial institution, these two functions are kept separate for an obvious reason. If the same person who makes the trades also checks the trades, there is no check at all. It's the financial equivalent of letting the student grade his own exam. At first, the problem was small. Leeson made a few bad trades. Minor losses, nothing catastrophic. But instead of reporting them, he hid them. He opened a secret account number 88888, and quietly moved his losses into it. On the surface, his trading record looked spectacular. In 1993, his reported profits accounted for nearly 10% of Barings' total earnings. He was celebrated, promoted, given a bonus. His superiors in London had no reason to question him. Why would they? He was making the money. But underneath the success, the losses were growing. And Leeson was doing what every gambler in history has done when they're losing. Doubling down, making bigger bets to cover smaller losses. Digging the hole deeper and deeper, convinced that the next trade would be the one that brought him back to even. And then, on January 17th, 1995, something happened that no amount of trading strategy could account for. The Great Hanshin Earthquake. It struck Kobe, Japan, at 5:46 in the morning. 6,434 people died. The earthquake devastated one of Japan's most important economic centers. And it sent the Japanese stock market into freefall. Leeson's positions were wiped out. Not partially, completely. The losses in account, 888, exploded. And instead of stopping, instead of confessing, Leeson doubled down again, and again, and again. He was betting that the Japanese market would recover quickly. It didn't. By February 23rd, the losses had reached £827 million. That's $1.4 billion. More than twice Barings' entire trading capital. The bank was finished. Leeson wrote his note. "I'm sorry." He fled Singapore. He made it to Malaysia, then Thailand, then Germany, where he was finally arrested at Frankfurt Airport while trying to board a flight to London. Within days, Barings Bank, the institution that had survived Napoleon, 2 world wars, and the Great Depression, was declared insolvent and sold to the Dutch bank ING for the sum of £1. 1 single pound. Leeson was extradited to Singapore and sentenced to 6.5 years in Changi prison. He was diagnosed with colon cancer while serving his sentence, but survived. He was released in 1999. And here's the coda that makes this story feel almost scripted. After prison, Nick Leeson became a motivational speaker. He now travels the world, giving talks about risk management and corporate responsibility. He charges thousands of dollars per appearance. The man who destroyed a 233-year-old bank now gets paid to tell other people how not to destroy theirs. But here's the question that nagged at investigators long after the collapse. How did nobody at Barings notice? How did a 28-year-old in Singapore accumulate losses of more than $1 billion without anyone in London raising an alarm? The answer, of course, is that they didn't want to look. Leeson was making money, or so they thought. And in finance, when someone is making you money, you don't ask too many questions. You don't look too closely at the numbers. You don't verify the trades. You just enjoy the profits. Leeson destroyed one bank, but the criminals we're about to meet, they nearly destroyed the entire financial system. And they started with something called a junk bond. The 1980s arrived on Wall Street like a shot of adrenaline. Reaganomics, deregulation, tax cuts, a cultural shift that reframed wealth not as something to be embarrassed about, but something to celebrate. And for a brief, dazzling, dangerous period, Wall Street became the center of the American universe. The money was enormous, the suits were sharp, The cocaine was everywhere, and the criminals, they were treated like rock stars. Let's start with the man who inspired one of the most famous movie characters in history. Even Boesky was an arbitrageur. That's a fancy word for someone who bets on companies that are about to be acquired. When Company A announces it's buying Company B's stock price usually jumps. If you know about the deal before it's announced, well, you can make a fortune. And that's exactly what Boesky did. He cultivated a network of investment bankers and corporate insiders who fed him information about upcoming mergers and acquisitions. He was making $200 million a year. $200 million. In the 1980s, that was an almost incomprehensible sum. But Boesky wasn't just making money. He was building a philosophy around it. In 1985, he gave a commencement speech at UC Berkeley's School of Business, and he said something that would define an era. He told the graduates that greed was healthy, that greed was right, that greed worked. The audience applauded. 2 years later, the writer Oliver Stone would take that speech and put it in the mouth of a fictional character named Gordon Gekko, played by Michael Douglas in the film Wall Street. The line was meant as a warning. It became a recruitment pitch, but behind the philosophy, the truth was simpler. Boesky was cheating. He was trading on insider information. And in 1986, the federal government, led by an ambitious U.S. attorney named Rudy Giuliani, caught him. Now, here's where Boesky made his most important calculation. When faced with the full weight of federal prosecution, he did what any self-interested Wall Street operator would do. He made a deal. Boesky agreed to wear a wire, to record his conversations with other Wall Street insiders, to become a cooperating witness, and the biggest fish he helped the government catch, his own associate, a man named Michael Milken. Michael Milken was something new. At the investment bank Drexel Burnham Lambert, Milken had essentially invented the modern junk bond market. Before Milken, companies without pristine credit ratings were largely shut out of the capital markets. They couldn't raise money. They couldn't grow. Milken changed that. He proved that high-yield bonds from risky companies that paid higher interest rates, could be bundled and sold profitably. It was, by any measure, a genuine financial innovation. Milken made it possible for thousands of companies to access capital they never would have had. He fueled the leveraged buyout boom of the 80s. Corporate raiders used Milken's junk bonds to take over companies many times their size. The amounts of money involved were staggering. But the innovation came with a dark side. Milken's operation at Drexel Burnham Lambert was also engaged in insider trading, stock manipulation, fraud, and, most damningly, racketeering. In 1989, a federal grand jury indicted Michael Milken on 98 counts of racketeering and fraud. And here's a detail that most people don't know. This was the first time in American legal history that the RICO Act, the Racketeer Influenced and Corrupt Organizations Act, originally designed to prosecute the mafia, was used against a Wall Street executive. Let that sink in. The law they used to take down mob bosses was now being used on a bond trader. Milken ultimately pleaded guilty to 6 charges, was sentenced to 10 years in prison, and paid $600 million in fines and settlements. He served 22 months. And in 2020, he was pardoned by President Trump. But the damage was already done, not by Milken's prosecution, by his invention. Because the junk bonds that Milken had created didn't just fuel corporate takeovers, they became the weapon of choice for a different kind of criminal entirely. His name was Charles Keating, and the wreckage he left behind would cost American taxpayers $160 billion. To understand Charles Keating, you need to understand the savings and loan industry. In the early 1980s, Congress deregulated savings and loan associations, essentially small community banks that took deposits and made home loans. The new rules allowed S&Ls to invest in things they'd never been allowed to touch before: junk bonds, commercial real estate, speculative ventures. The idea was that deregulation would make S&Ls more competitive. What it actually did was hand them a loaded gun and tell them to have fun. Charles Keating saw the opportunity immediately. He bought Lincoln Savings and Loan in California for $51 million. When asked later why he'd gotten into the S&L business, his answer was disarmingly honest. He said, and I'm not making this up, he said he always felt that an S&L, if they'd relax the rules, was the biggest moneymaker in the world. He was right. Under Keating's leadership, Lincoln's assets grew from $1.1 billion to $5.5 billion. On paper, it looked like a miracle of financial management. In reality, most of those assets were fictional, created through deceptive accounting practices. But the real crime, the one that still makes people's blood boil decades later, was what Keating did to the depositors. He sold high-risk junk bonds directly to Lincoln's customers. Many of them were elderly retirees who'd come in to open simple savings accounts. They were told the bonds were safe. They were told they were government-backed. They were neither. When Lincoln Savings collapsed in 1989, 23,000 bondholders lost their savings. 23,000 people, many of them elderly, many of them unable to recover financially. The cost to the federal government was $3.4 billion. And then there was the political dimension. Keating hadn't just bought bonds. He'd bought senators. 5 of them: Alan Cranston, Dennis DeConcini, John Glenn, John McCain, Donald Regal. They became known as the Keating Five. Keating had given them a combined $1.5 million in campaign contributions. In return, the senators pressured federal banking regulators to back off their investigation of Lincoln Savings. They delayed the closure of the institution by years during which more depositors were defrauded, more money was lost, more elderly investors were wiped out. Keating was eventually convicted on 73 counts of fraud, racketeering, and conspiracy. He was sentenced to 12.5 years. But in a twist that would become a recurring theme in this story, his convictions were later overturned on technicalities. He pleaded guilty to lesser charges in 1999 and served no additional time. The savings and loan crisis as a whole was catastrophic. Over 1,000 S&Ls collapsed. The total cost has been estimated at anywhere from $160 billion to $600 billion. Until the subprime mortgage crisis of 2008, it was considered the worst financial disaster in American history since the Great Depression. And it all connected back to one chain. Boesky traded on inside information. Boesky led to Milken. Milken created the junk bonds. Keating used those junk bonds to loot the savings and loan system. One domino after another, stretching from a wire on Ivan Boesky's chest to 23,000 retirees who lost everything. The 1980s proved that Wall Street could destroy banks. The 2000s would prove it could destroy entire companies and take the people who trusted them down too. Now, before we get to the biggest corporate frauds in American history, I want to take you on a detour because this story has two characters who represent something essential about Wall Street crime: the art of the con itself. Not the manipulation of numbers or the rigging of markets, but the oldest trick of all: telling people what they want to hear. The first is the man whose name became a crime. Charles Ponzi arrived in Boston in 1903 with $2.50 in his pocket. He was an Italian immigrant with a criminal record that already included time in a Canadian prison for check forgery. He was not, by any reasonable assessment, a trustworthy financial advisor. But Ponzi had something that most fraudsters lack. He had charm, and he had an idea that sounded just plausible enough to work. The idea was based on international reply coupons, postal certificates that could be purchased cheaply in one country and redeemed at a higher value in another. The arbitrage was real. On paper, there was a legitimate profit to be made, and Ponzi pitched it brilliantly. He told investors they could earn 50% returns in 45 days, 100% in 90 days. The money poured in, and for a while, Ponzi delivered on his promises. Early investors received their returns on time and with interest. What they didn't know was that Ponzi had never invested their money in postal coupons. He was paying them with money from newer investors. The classic con, the scheme that would forever bear his name. At its peak, Ponzi was taking in $250,000 a day. He'd arrived in America with $2.50. Now, he was living in a mansion, wearing tailored suits, and being treated as a financial genius. It lasted about a year. In August of 1920, a newspaper investigation revealed the truth. Ponzi had stolen $20 million, equivalent to about $237 million today. His scheme caused 6 banks to fail. He was convicted of mail fraud and spent 14 years in prison. After his release, he was deported to Italy, drifted through Brazil, and died in poverty in 1949. He was buried in a pauper's grave. But his legacy was immortal, not the money, not the scheme, the name. Every fraud of its kind that followed, and there would be many, including the biggest in history, would be called a Ponzi scheme. One man's crime became the English language's word for a certain type of theft. Now, let's jump forward 7 decades. Different century, same species. Jordan Belfort grew up in Queens, New York. He was bright, ambitious, and had what people in sales called the gift. He could sell anything to anyone. And in the late 1980s, he found the perfect product: worthless stocks. Belfort's company, Stratton Oakmont, was a boiler room operation, a high-pressure brokerage that employed hundreds of aggressive young salespeople. Their job was to call potential investors, often people who had no business buying speculative penny stocks, and convince them to invest. The technique was straightforward. Stratton Oakmont would buy large quantities of a cheap stock. Then the salespeople would push it hard to retail investors. The buying pressure would inflate the price, and then Belfort and his partners would sell their shares at the inflated price. It's called a pump and dump, and it's one of the oldest scams in finance. The same basic trick that Michael Meehan's stock pools were running in the 1920s. The only difference was the technology. Instead of manipulating the ticker tape, Belfort was manipulating the telephone. Over the course of the 90s, Belfort defrauded investors out of approximately $200 million. He lived a life of almost cartoonish excess. Yachts, helicopters, parties that became the stuff of Wall Street legend. In 2003, he was sentenced to 4 years in prison. He served 22 months. He was ordered to pay $110 million in restitution to his victims. By 2018, he had paid about $13 million. His solution for making up the difference? Become a motivational speaker. He now earns millions of dollars teaching people how to sell, which is, if you think about it, exactly the skill that got him arrested in the first place. But the final detail about Jordan Belfort's story, the one that ties it to a much larger crime we haven't gotten to yet, involves a movie. In 2013, Martin Scorsese directed The Wolf of Wall Street, starring Leonardo DiCaprio as Belfort. The film cost $100 million to make, and the money that funded it, the production financing, came from a company controlled by a young Malaysian businessman named Joe Low. Now, at the time, nobody knew where Joe Low's money came from. He threw extravagant parties in Hollywood. He dated models. He bought art. He seemed to have an unlimited supply of cash. The truth, which would emerge years later, was that Joe Low was the key orchestrator of one of the largest financial crimes in modern history. A $4.5 billion fraud involving a Malaysian sovereign wealth fund called 1MDB. We'll get to that story soon. But I want you to hold on to this detail. A movie about Wall Street crime, funded by the proceeds of an active Wall Street crime. You can't write irony that good. Ponzi and Belfort were, in many ways, small-time operators. Brilliant salesmen, yes, but the damage they did was measured in millions. The criminals we're about to meet? Their damage was measured in the hundreds of billions. And they didn't operate out of boiler rooms or back offices. They ran some of the most respected corporations in America. By the late 1990s, a new kind of Wall Street criminal had emerged. Not the rogue trader, not the boiler room operator, not the inside tipster. This was something different. This was the CEO, the corporate executive who stood in front of shareholders and analysts and the television cameras and lied. Not about one trade or one quarter, about everything. For years. The first and most devastating example was Enron. In the year 2000, Enron was the 7th largest company in the United States by revenue. $101 billion. It had 20,000 employees. Its stock traded at around $90 a share. Fortune magazine had named it America's most innovative company for 6 consecutive years. And it was a fraud, top to bottom. A house of cards built on accounting tricks so sophisticated that even the people investigating them had trouble understanding what they'd found. The architect of the deception was Enron's chief financial officer, Andrew Fastow. Fastow created an elaborate web of what are called special-purpose entities, essentially shell companies that existed only on paper. Their function was simple: to hold Enron's debt. By moving liabilities off Enron's balance sheet and onto these phantom companies, Fastow made it look like Enron was far more profitable and far less indebted than it actually was. But Fastow wasn't just hiding Enron's problems. He was enriching himself. Several of the special-purpose entities were designed to funnel money directly to Fastow and his associates. He was looting the company and covering his tracks at the same time. Meanwhile, Enron's CEO, Jeffrey Skilling, and its chairman, Kenneth Lay, continued to tell investors that everything was fine. Better than fine. Excellent. Record-breaking. They sold millions of dollars worth of their own Enron stock while publicly proclaiming confidence in the company's future. When the truth finally emerged in late 2001, the collapse was total. Enron's stock went from $90 to less than $1. 20,000 employees lost their jobs. Many of them had their retirement savings invested in Enron stock, savings that were now worthless. But the damage extended far beyond Enron itself. The company's auditor, Arthur Andersen, was one of the Big Five accounting firms. Andersen had signed off on Enron's financial statements year after year. When investigators came knocking, Andersen employees began shredding documents. The firm was convicted of obstruction of justice. 28,000 people at Arthur Andersen lost their jobs, not because of what they did, but because of what their firm failed to catch. Skilling was convicted on 19 of 28 counts, including insider trading, and sentenced to 24 years in prison, later reduced to 14. Lay was convicted on all 6 counts against him, but he died of a heart attack before he could be sentenced. Fastow cooperated with prosecutors and received a reduced sentence of 6 years. Congress responded with the Sarbanes-Oxley Act of 2002, one of the most significant pieces of corporate governance legislation in American history. It was supposed to make another Enron impossible. Supposed to. Remember that. Because while Enron was collapsing, another corporate fraud was quietly metastasizing inside one of America's largest telecommunications companies, WorldCom. Under the leadership of CEO Bernard Ebbers, WorldCom had grown through an aggressive series of acquisitions to become a telecom giant. But the growth masked a fundamental problem. The company wasn't nearly as profitable as it claimed. The solution? Cook the books. WorldCom's chief financial officer, Scott Sullivan, directed his accounting staff to classify billions of dollars in ordinary operating expenses as capital expenditures. This made the company's profits look much larger than they actually were. The total amount of accounting fraud? More than $7 billion. The fraud was discovered by WorldCom's own internal auditor, a woman named Cynthia Cooper. Cooper had noticed irregularities in the company's accounts and began investigating on her own. working nights and weekends to avoid detection by the executives she suspected were involved. What she found was devastating. Billions in fake entries, a complete fabrication of the company's financial position. Cooper reported her findings to WorldCom's board of directors. The company disclosed the fraud in June 2002. It filed for bankruptcy, at the time the largest in American history, surpassing Enron. Ebers was sentenced to 25 years in prison. Sullivan, who cooperated, received 5 years. Cynthia Cooper was named one of Time magazine's Persons of the Year in 2002. She is one of the few genuine heroes in this entire story. Now, after Enron and WorldCom, you might think the trend was clear. Corporate fraud on a massive scale, devastating consequences, real prison sentences. Surely that would be enough to scare the next generation straight. But before we get to the financial crisis that would make all of this look like a dress rehearsal, there's one more story from this era that deserves telling. Not because the fraud was the biggest, but because it was the most absurd. Dennis Kozlowski was the CEO of Tyco International. Under his leadership, Tyco had become a massive conglomerate through a series of acquisitions. Kozlowski was celebrated as a brilliant dealmaker. Fortune magazine called him the most aggressive CEO in America. What the magazines didn't know was that Kozlowski was using Tyco as his personal piggy bank. He borrowed $270 million from the company through a loan program designed for executives. $242 million of that was spent on personal expenses. His apartment in Manhattan, which Tyco paid for, cost $30 million. Inside it, investigators found a shower curtain that cost $6,000. A dog umbrella stand that cost $15,000, artwork totaling $14.7 million. But the detail that made Kozlowski famous, the image that defined an era of corporate excess, was the birthday party. In 2001, Kozlowski threw a 40th birthday party for his second wife on the island of Sardinia. The party cost $2 million. Tyco paid half. There were gladiators, there was a birthday cake in the shape of a woman's torso, and there was an ice sculpture of Michelangelo's David that dispensed vodka. I'll let you imagine from where. At his trial, the jury was shown video of the party. The prosecution didn't need to explain the charges. They just needed to press play. Kozlowski was convicted on more than 30 counts of fraud and grand larceny. He was sentenced to 8 1/3 to 25 years. He served about a decade. He paid $167 million in restitution and fines. Tyco itself paid $2.92 billion to defrauded shareholders. And, as for the shower curtain, Kozlowski himself later admitted it had a significant influence on his conviction. He said jurors could sit through 4 months of testimony about compensation committee meetings without flinching. But when the prosecution showed them a $6,000 shower curtain, more than many people's monthly rent, they knew they were looking at a criminal. The early 2000s had proven something uncomfortable. The biggest companies in America, the ones listed on the stock exchange, the ones in your retirement fund, the ones whose names you saw on the sides of stadiums, could be built entirely on lies, and the people running them could live like kings on stolen money. Congress passed Sarbanes-Oxley. The era of corporate fraud was supposed to be over. But while everyone was watching the boardrooms, the biggest fraud in history was running quietly in a Manhattan office. And the one person who figured it out, nobody would listen to him. Let me tell you about a man named Harry Markopolos. Markopolos was a financial analyst working for a Boston-based investment firm called Rampart Investment Management. He was not famous. He was not powerful. He was not connected. He was, by his own description, a numbers guy. Someone who spent his days looking at financial data, running mathematical models, and trying to understand how markets worked. In the year 2000, his boss gave him an assignment. There was an investment fund in New York that was generating extraordinary returns. Consistent, steady, year after year. The fund never seemed to have a losing month. Its results defied every model Markopolos could build. His boss wanted him to figure out the fund's strategy so that Rampart could replicate it. The fund was called Bernard L. Madoff Investment Securities. Its founder was Bernie Madoff. And within 5 hours of looking at the numbers, Markopolos came to a conclusion that would haunt him for the next 8 years. The returns were impossible, not unlikely, not improbable, mathematically impossible. The fund's reported performance could not be generated by any legitimate trading strategy. The only explanation was fraud. Markopolos did what any reasonable person would do. He reported it. In 2000, he submitted his first complaint to the Securities and Exchange Commission. He laid out his analysis. He showed the math. He explained why Madoff's returns couldn't be real. The SEC did nothing. Markopolos submitted more complaints in 2001, in 2005, in 2007. Each time, he provided more evidence, more analysis, more mathematical proof that Madoff was running a Ponzi scheme. In 2005, he sent the SEC a detailed report with one of the most extraordinary titles in the history of financial regulation. He called it, "The World's Largest Hedge Fund is a Fraud." The SEC still did nothing. For 8 years, Harry Markopolos, a man with no power, no authority, and no platform, knew the truth about the biggest financial fraud in history. He had the evidence, he had the math, he had the conviction, and nobody listened. Not because the evidence was weak, but because Madoff was too respected, too connected, too important. A former chairman of NASDAQ, a pillar of the financial establishment. The fraud was hiding in plain sight, and the people whose job it was to find it didn't want to look. Now, who was Bernie Madoff? He was born in 1938 in Queens, New York. He started his career trading penny stocks in the early 1960s with $5,000 he'd saved from working as a lifeguard and a sprinkler installer. By the 1980s, he had built Bernard L. Madoff Investment Securities into one of the largest market-making firms on Wall Street. He helped develop the electronic trading technology that would eventually be adopted by NASDAQ. He served as chairman of the NASDAQ Stock Exchange in 1990. He was, by every external measure, the embodiment of Wall Street success. Respected, admired, trusted. And for at least 2 decades, possibly longer, he was running the largest Ponzi scheme in human history. The mechanics were almost insultingly simple. Investors gave Madoff their money. Madoff didn't invest it. When existing investors wanted to withdraw, he paid them with money from newer investors. As long as more money was coming in than going out, the scheme could sustain itself. And for decades, it did. Because Madoff was a genius at one thing above all else: creating an aura of exclusivity. You didn't apply to invest with Madoff. You were invited, or you were referred by someone already in the club. Madoff deliberately cultivated the impression that his fund was difficult to access, that getting in was a privilege. He exploited the most basic human instinct, the fear of missing out. If everyone else was making 12% a year with Madoff, you wanted in too. And once you were in, you didn't ask questions. Asking questions might get you kicked out. His victims included Steven Spielberg, Larry King, Kevin Bacon, Nobel laureate Elie Wiesel's foundation, banks, universities, charities, pension funds, thousands upon thousands of ordinary people who'd trusted their retirement savings to a man whose numbers were too good to be true. Literally. The end came in December 2008. The global financial crisis had triggered a wave of investor withdrawals. Madoff received $7 billion in redemption requests that he couldn't meet. On December 10th, he called his 2 sons, Mark and Andrew, to his apartment and told them the truth. The investment advisory business, he said, was just one big lie, a giant Ponzi scheme. It had been going on for years. His sons turned him into federal authorities the next day. The total amount of the fraud was staggering: $64.8 billion. It was not just the largest Ponzi scheme in history. It was the largest financial fraud of any kind in history. Madoff pleaded guilty to 11 federal felonies, including securities fraud, money laundering, and perjury. On June 29, 2009, he was sentenced to 150 years in prison, the maximum allowed. The judge called his crimes extraordinary evil. He died in a federal medical center in North Carolina on April 14, 2021. He was 82 years old. He had served 12 years of his 150-year sentence. In the years since his arrest, a court-appointed trustee has recovered a remarkable amount of the stolen money. As of 2025, the Madoff Victim Fund has distributed over $4.22 billion to more than 40,000 victims, recovering approximately 91% of their losses. It is one of the most successful fraud recovery efforts in history. But here's what stays with me about the Madoff story. It's not the $64 billion. It's not the famous victims. It's not even the 150-year sentence. It's Harry Markopoulos, sitting in his office in Boston, running the numbers, knowing the truth, writing reports that no one would read. For 8 years, the system didn't fail because it couldn't detect fraud. The system failed because it didn't want to. Madoff was too important, too connected, too respectable. And respectability, as we've seen throughout this story, is the most dangerous weapon a criminal can have. Madoff stole $64 billion from people who trusted him. But what happened next? What happened next would make even Madoff look small, because in 2008, it wasn't one man lying. It was the entire system. 2008. If you were alive and old enough to understand what was happening, you remember it. The feeling. That slow, creeping dread as the news got worse every single day. Banks failing. Stock markets collapsing. Headlines that sounded like they'd been written by a disaster novelist. But let me start with a specific date. September 15th, 2008. On that day, Lehman Brothers, one of the oldest and most prestigious investment banks on Wall Street, filed for Chapter 11 bankruptcy. It was the largest bankruptcy filing in American history. More than $600 billion in assets gone overnight. The collapse of Lehman Brothers didn't just shake Wall Street. It shook the world. The Dow Jones fell 4.5% in a single day. Credit markets froze. Banks stopped lending to each other. Companies couldn't make payroll. The global economy, which had been teetering on the edge for months, fell off the cliff. But here's what you need to understand. The 2008 financial crisis wasn't a natural disaster. It wasn't an earthquake or a pandemic or an act of God. It was a crime. Or more precisely, it was 1,000 crimes committed by hundreds of people over the course of more than a decade. And when it was over, the total cost was almost beyond comprehension. 8.8 million Americans lost their jobs. 10 million families lost their homes to foreclosure. The U.S. government spent $700 billion bailing out the financial system through a program called TARP, the Troubled Asset Relief Program. Retirement accounts across the country lost trillions of dollars in value. The global economy contracted by an estimated $22 trillion. And at the center of it all, the banks. Here's the short version of what happened. In the early 2000s, American banks discovered they could make enormous profits by issuing mortgages to people who couldn't afford them. These were called subprime mortgages, loans given to borrowers with poor credit, often with low initial payments that would skyrocket after a few years. The banks knew many of these borrowers would default. They didn't care, because they weren't going to hold the mortgages. Instead, they bundled thousands of subprime mortgages together into complex financial instruments called mortgage-backed securities. They sliced and diced these securities into different risk levels. They got the credit rating agencies, companies like Moody's and Standard and Poor's, to rate many of these bundles as AAA, the safest possible rating, and then they sold them to investors around the world. It was an assembly line of fraud. Banks making bad loans, rating agencies blessing them, investors buying them. And at every step, everyone was making money. Until the borrowers started defaulting, until the housing market collapsed, until the whole edifice came crashing down. Now, in this story, I want to focus on one particular institution because it illustrates everything that was wrong with the system: Lehman Brothers. Lehman's CEO was Richard Fuld. Fuld had been running Lehman since 1993. And under his leadership, the firm had become increasingly aggressive in its pursuit of profits. It had loaded up on real estate investments and mortgage-backed securities. It had taken on enormous amounts of leverage, borrowing $30 for every $1 of its own capital. But what made Lehman's story truly criminal was a practice called Repo 105. Repo 105 was, in essence, an accounting trick. Before Lehman published its quarterly financial statements, it would temporarily sell up to $50 billion worth of assets to a shell company it controlled. This made Lehman's balance sheet look much healthier than it actually was. It reduced the firm's apparent leverage ratio from 13.9 to a far more palatable 12.1. And then, a few days after the financial statements were published, the assets would quietly reappear on Lehman's books. The bankruptcy examiner who investigated Lehman, a man named Anton Valukas, described it with a single, damning phrase. He called it a shell game. For years, this maneuver helped Lehman present a misleading picture of its financial health to investors, regulators, and the public. Lehman's chief financial officer approved it. The CEO certified the financial statements. The auditor, Ernst & Young, either didn't catch it or didn't care. When Gould was called before Congress, he told the committee he had absolutely no recollection of hearing anything about Repo 105. The bankruptcy examiner's report tells a different story. Evidence showed that Lehman's president had discussed it with Gould directly and that documents describing the transactions had been shared with him. Here's the number that matters. From 2000 to 2007, Richard Gould was compensated approximately $529 million. Salary? Bonuses? Stock sales? $529 million. He was never charged with a crime. He kept the money. He opened a consulting firm called Matrix Advisors. He still owns homes in Greenwich, Connecticut, Jupiter Island, Florida, and Sun Valley, Idaho. Now, the story of 2008's aftermath is in many ways more disturbing than the crisis itself. Because nobody went to jail. That's not hyperbole. It's fact. In the 4 years following the worst financial crisis since the Great Depression, the number of Wall Street CEOs prosecuted for fraud was 0. The SEC brought civil charges against more than 150 people and collected $2.68 billion in penalties. But not a single senior executive from any of the major banks faced criminal prosecution. The only banker in the entire United States sentenced to prison for his role in the financial crisis was a man named Karim Serageldin. He was a mid-level executive at Credit Suisse who had mismarked the prices of mortgage-backed bonds to hide losses. His sentence? 30 months. And here's the detail that takes this from outrageous to surreal. In the years following the crisis, the government did bring criminal charges related to mortgage fraud. Against one bank? A single bank. Its name was Abacus Federal Savings. It was a tiny community bank in New York's Chinatown, serving the Chinese-American community. It had one branch. While the biggest banks in the world, the ones that had packaged and sold trillions of dollars in toxic securities, the ones that had crashed the global economy, The ones that had been bailed out with $700 billion of taxpayer money, while those banks paid fines and continued operating as if nothing had happened. Abacus Federal Savings was indicted on criminal charges. The trial lasted 2 months. Abacus was acquitted on all counts. Let me make sure that sinks in. The biggest financial crime in modern history destroyed 8.8 million jobs. The government's criminal prosecution of the banking industry consisted of one mid-level trader who got 30 months and one tiny community bank that was found not guilty. When former Attorney General Eric Holder was asked why no senior Wall Street executives were prosecuted, his answer has become one of the most quoted and most infuriating lines in the history of American justice. He said, "We simply didn't have the proof." A professor named William Black, who had helped prosecute the savings and loan crisis in the 1980s, offered a different explanation. During the S&L crisis, regulators had made thousands of criminal referrals to prosecutors. During the 2008 crisis, 0. Not one. The referrals that would have launched the investigations simply never came. The 6 biggest banks paid over $181 billion in fines and settlements for their role in the crisis. $181 billion. It sounds like a lot, but for banks that were earning hundreds of billions in revenue per year, it was a cost of doing business. 2008 proved what a century and a half of Wall Street history had been building toward. The bigger the crime, the smaller the consequence. The more people you hurt, the less likely you are to face justice. The fines get paid, the stock price recovers, the bonuses come back, and the system continues. As one former Inspector General put it, the folks responsible for this incredibly painful economic damage have gone free. 2008 was supposed to be the wake-up call. Congress passed the Dodd-Frank Act. The system would be reformed. Oversight would be strengthened. Never again. Sound familiar? It should, because the next decade would prove that nothing, absolutely nothing, had changed. While the world was reeling from the 2008 crisis, while millions of people were losing their homes and their jobs and their savings, something else was happening behind the scenes at the world's biggest banks. They were rigging the global interest rate. LIBOR, the London Interbank Offered Rate. Unless you work in finance, you've probably never heard of it. But for decades, LIBOR was the most important number in the global economy. It was the benchmark interest rate that determined how much banks charged each other for short-term loans. And because it was the benchmark, it affected everything downstream. Mortgages, student loans, credit cards, corporate debt, government bonds. The total value of financial instruments tied to LIBOR was estimated at more than $300 trillion. That's not a typo, 300 trillion. And it was being set by a system that was, frankly, absurd. Every morning, a panel of the world's major banks would submit their estimates of how much it would cost them to borrow from other banks. The highest and lowest submissions were thrown out. The rest were averaged. And that average became LIBOR for the day. The problem? The submissions were based on estimates, not actual transactions. Banks were essentially telling the world how much they thought they'd have to pay to borrow, and there was nothing stopping them from lying. Between 2005 and 2009, they did exactly that. Traders at Barclays, UBS, Royal Bank of Scotland, Deutsche Bank, JP Morgan, Citibank, HSBC, and others manipulated their LIBOR submissions for two reasons. First, to make money. Traders who held derivatives, contracts that were tied to LIBOR, could profit by nudging the rate in one direction or another. And the evidence shows they did this casually, almost offhandedly. In messages that were later produced in court, traders asked each other for rate-setting favors the way you might ask a coworker to grab you a coffee. Second, to hide vulnerability. During the financial crisis, some banks submitted artificially low LIBOR estimates to make it look like they could borrow cheaply, a signal to the market that they were financially healthy, even when they weren't. The scale of the manipulation is almost impossible to grasp. It affected interest rates on hundreds of trillions of dollars in financial instruments. Every homeowner with a variable rate mortgage was affected. Every student with a floating rate loan. Every government that had issued LIBOR-linked debt. The consequences, when they finally came, were significant, but selective. Banks were fined a total of more than $9 billion. Tom Hayes, a British trader who worked for UBS and then Citigroup, became the first person convicted for LIBOR manipulation. He was sentenced to 14 years in prison. Barclays CEO, Bob Diamond, and Chairman Marcus Agius both resigned. Regulators in at least 10 countries on 3 continents investigated. But the deeper issue, that the world's most important interest rate had been set by a system based on unverified self-reporting by the very institutions that profited from manipulating it, took far longer to address. LIBOR was eventually phased out as a benchmark, replaced by rates based on actual transactions rather than estimates. The LIBOR scandal showed something important. You don't need a single criminal mastermind to commit one of the largest frauds in history. You just need a system that trusts powerful institutions to tell the truth, and a culture that never checks. LIBOR was a quiet crime, mundane even, traders nudging numbers on a screen. But the next fraud we're going to talk about? It was anything but quiet. It involved a stolen nation, a $250 million yacht, and a Hollywood movie. In 2009, the Malaysian government created a sovereign wealth fund called 1MDB, One Malaysia Development Berhad. Its stated purpose was to attract foreign investment and fund development projects that would benefit the Malaysian people. The fund was overseen by Malaysia's Prime Minister, Najib Razak. In 2012 and 2013, Goldman Sachs helped 1MDB raise $6.5 billion through a series of bond offerings. Goldman earned approximately $600 million in fees for this work. Now, $600 million in fees on $6.5 billion in bonds works out to roughly 9%. In the world of bond underwriting, where fees typically run around 1%, this was extraordinarily, some would say suspiciously, high. Authorities would later determine that more than $4.5 billion of the money raised was stolen, siphoned into offshore shell companies, laundered through a network of banks and intermediaries spanning multiple continents. And at the center of the theft was a man who held no official position at 1MDB, had no formal title, and wasn't even a government employee. His name was Joe Low. He was a young Malaysian businessman with high-level political connections and an apparently limitless appetite for spending other people's money. Low used the stolen funds to purchase luxury real estate in New York, Beverly Hills, and London. He acquired a $250 million yacht. He bought artwork by Claude Monet and Vincent van Gogh. He threw celebrity-studded parties that became legendary in Hollywood circles. He dated models. He flew private. He spent money with the reckless abandon of someone who knew it wasn't his. And then there's the detail that elevates this story from a financial crime into something approaching cosmic irony. In 2013, Martin Scorsese released The Wolf of Wall Street, a film about Jordan Belfort's pump and dump crimes. The production was financed in significant part by Red Granite Pictures, a company linked to Joe Low, a movie about Wall Street crime, funded by the proceeds of a Wall Street crime. Let me say that one more time, because it bears repeating. The movie about a man who defrauded investors was financed with money stolen from an investment fund meant to help the Malaysian people. You cannot write irony that good. The universe had to do it for you. When the scheme was finally uncovered, the fallout was global. Tim Leissner, Goldman Sachs' former chairman of Southeast Asia, pleaded guilty to conspiracy charges. He was sentenced to 2 years in prison. Roger Nang, another Goldman banker, was convicted of bribery and corruption and sentenced to 10 years. Goldman Sachs itself reached a $3.9 billion settlement, one of the largest penalties in Wall Street history. Its Malaysian subsidiary pleaded guilty to a corruption charge. Malaysia's Prime Minister, Najib Razak, was prosecuted in Malaysian courts and sentenced to 12 years in prison for corruption and money laundering. The case inspired what some called a people-powered revolution that pushed Najib from power. And Joe Low, as of 2026, he remains a fugitive. He is believed to be living somewhere in China. Interpol has issued a red notice for his arrest. The U.S. Department of Justice described the 1MDB case as the largest in the history of its kleptocracy asset recovery initiative. 14 countries investigated, billions of dollars tracked across continents, a prime minister jailed, a Goldman Sachs subsidiary pleading guilty, and at the center of it all, a young man with no title, no position, and no accountability, who used stolen money to fund a movie about stolen money. From a stolen nation's wealth, we move now to something more intimate. Because the next fraud didn't happen on Wall Street at all. It happened in a blood testing lab in Silicon Valley, and it fooled some of the most powerful people on Earth. In 2003, a 19-year-old named Elizabeth Holmes dropped out of Stanford University. She used her tuition money to found a company called Theranos. Her vision was revolutionary. A device that could perform hundreds of blood tests, from cholesterol to cancer markers, to genetic analysis, using just a single drop of blood from a fingertip prick. If it worked, it would transform healthcare. No more needles, no more vials, no more waiting days for results. Just one tiny drop, and you'd have answers in minutes. The problem was that it didn't work. Not then, not ever. And Elizabeth Holmes spent the next 12 years pretending that it did. Holmes had something that made her almost uniquely dangerous. She had the ability to make people believe, not just ordinary people, some of the most powerful, sophisticated, experienced people on the planet. Her board of directors read like a who's who of American power. Henry Kissinger, the former Secretary of State. William Perry, a former Secretary of Defense. James Mattis, who would later become Secretary of Defense under Trump. George Shultz, another former Secretary of State. Gary Rughead, a retired four-star admiral. These weren't naive investors. These were people who had navigated geopolitics, managed trillion-dollar defense budgets, and advised presidents. And they were completely fooled by a college dropout with a fake baritone voice and a black turtleneck. The investor list was equally staggering. Rupert Murdoch invested $121 million. The Walton family put in $150 million. Betsy DeVos invested $100 million. The Cox family added another $100 million. Larry Ellison, the co-founder of Oracle, wrote a check. Tim Draper, a legendary Silicon Valley venture capitalist, was the first major backer. At its peak, Theranos was valued at $9 billion. Elizabeth Holmes was celebrated as the youngest self-made female billionaire in America. She was on the cover of Forbes, Fortune, and Time. She was invited to the White House. She spoke at TED. She was, by every measure, a star. And the technology. The company's proprietary device could perform only a small number of tests. The vast majority of patient tests were run on modified commercial machines made by other companies, a fact that was concealed from investors, regulators, and the public. Theranos employees would frequently delete erroneous results to make the machines appear more accurate. Company reports were falsified. Inflated revenue figures were presented to investors. Holmes personally added logos of major pharmaceutical companies to marketing materials, companies that had no association with Theranos. The real-world consequences went beyond money. Real patients received real results from Theranos tests, and those results were often wrong. People were told they had conditions they didn't have. Others were told they were healthy when they weren't. One woman testified that she received a false positive for HIV from a Theranos test at a Walgreens, causing her significant emotional distress. Another patient's medication was changed based on faulty test results, which contributed to a heart attack. This wasn't just financial fraud. This was fraud that put human lives at risk. The person who brought it all down was a journalist. John Carreyrou, a two-time Pulitzer Prize winner at the Wall Street Journal, received a tip in 2015 that Theranos was faking its test results. After months of investigation, during which Holmes and Theranos deployed armies of lawyers to threaten sources and intimidate potential witnesses, Carreyrou published a bombshell exposé. The article revealed that Theranos was a fraud. The unraveling was swift. Regulators moved in. Walgreens terminated its partnership. Investors sued. The SEC charged Holmes and her partner, Ramesh Sunny Balwani, with massive fraud. In January 2022, after a months-long trial, Holmes was found guilty of 3 counts of wire fraud and 1 count of conspiracy. She was sentenced to 11 years in prison. Balwani was convicted on all 12 counts and sentenced to nearly 13 years. Combined, they were ordered to pay $452 million in restitution. The company, once valued at $9 billion, was liquidated for nothing. The Theranos story asks an uncomfortable question. How do you fool Henry Kissinger, James Mattis, Rupert Murdoch, and the richest families in America? The answer is the same answer that explains every fraud in this video. You tell them what they want to hear. You give them a story that's too good to question. You build a mask of respectability so impressive that nobody thinks to look behind it. Holmes proved that the right story could fool anyone. But the next criminal took it even further. He didn't just tell a good story, he built an entire philosophy around it. Sam Bankman-Fried didn't look like a Wall Street criminal. That was the point. While the fraudsters we've talked about so far, dressed in Armani suits, flew private jets, and lived in mansions, Bankman-Fried, known universally as SBF, cultivated a deliberately anti-establishment image. He wore shorts and t-shirts to meetings with senators. He slept on a beanbag in his office. He drove a Toyota Corolla. He talked openly about giving away most of his fortune to charity. He was, by his own carefully constructed narrative, the good guy of cryptocurrency. His philosophy was called effective altruism, the idea that you should make as much money as possible, not for yourself, but so you can give it away as effectively as possible. It was philanthropy, reimagined for the tech age, and SBF was its poster child. Born in 1992 to 2 Stanford Law School professors, Bankman-Fried graduated from MIT in 2014. He worked briefly at the trading firm Jane Street Capital before founding Alameda Research, a quantitative cryptocurrency trading firm in 2017. In 2019, he founded FTX, a cryptocurrency exchange that quickly became one of the largest in the world. FTX grew at a staggering pace. By January 2022, it was valued at $32 billion. SBF's personal net worth was estimated at $16 billion. He appeared on the covers of Forbes and Fortune. He met with members of Congress. He donated more than $100 million to political campaigns on both sides of the aisle. He was invited to Davos, the annual gathering of the world's most powerful business and political leaders. And behind the beanbag, behind the t-shirts, behind the philosophy of giving it all away, he was stealing it. The mechanics of FTX's fraud were at their core remarkably simple. FTX was a cryptocurrency exchange, a platform where people bought and sold digital currencies. Customers deposited their money with FTX, trusting that it would be held safely and used only for their transactions. Instead, SBF secretly funneled customer funds to Alameda Research, his separate trading firm. Alameda used this money to make speculative investments, buy real estate, and make the political donations that were burnishing SBF's public image. According to prosecutors, At least $8 billion in customer money was diverted. And here's the detail that makes it even worse. Alameda Research had a secret exemption from FTX's auto-liquidation protocol. Every other trader on the platform was subject to automatic safeguards that would close their positions if they lost too much money. Alameda was exempt. It was playing by different rules than everyone else, and no one outside the inner circle knew. John J. Ray III, the man appointed to oversee FTX's bankruptcy, the same man, incidentally, who had overseen the Enron bankruptcy, described what he found as a complete failure of corporate controls. The company's balance sheet listed $9 billion in liabilities and $900 million in assets, a gap of $8 billion. Entries were poorly labeled. Records were incomplete. Some assets were tracked on a spreadsheet. The unraveling began on November 2nd, 2022, when the cryptocurrency news site CoinDesk published an article revealing that Alameda Research held a suspiciously large amount of FTX's own exchange token, FTT. The article triggered a spike in customer withdrawals. Within 72 hours, customers tried to pull $6 billion from the exchange. The money wasn't there. On November 11th, FTX, Alameda Research, and more than 100 affiliated entities filed for bankruptcy. What followed was one of the most dramatic legal collapses in recent memory. SBF's top lieutenants, Caroline Ellison, Gary Wang, and Nishad Singh, all pleaded guilty and cooperated with prosecutors. At trial, all three testified that it was Bankman-Fried who directed them to commit fraud. In November 2023, a jury convicted SBF on all 7 criminal counts, including wire fraud, securities fraud, money laundering, and campaign finance violations. On March 28, 2024, he was sentenced to 25 years in federal prison. The judge noted that SBF had shown no remorse. Prosecutors called it one of the biggest financial crimes in American history. SEC Chair Gary Gensler said Bankman-Fried had built a house of cards on a foundation of deception. And here's what makes SBF's story feel like the final evolution of every fraud we've discussed in this video. The mask. Every Wall Street criminal in this story wore a mask. Madoff wore the mask of exclusivity. Holmes wore the mask of innovation. Keating wore the mask of respectability. But SBF, he wore the mask of morality itself. He didn't just claim to be honest, he claimed to be saving the world. He framed his wealth accumulation as a moral duty. He argued, with a straight face, that the best way to help people was to make as much money as possible, and that he could be trusted to give it away wisely. It was the most sophisticated mask in the history of Wall Street crime, and underneath it was the same thing that's always been underneath: someone taking other people's money. The story of FTX raises a question that has echoed through this entire video, from Jay Gould in 1869 to Sam Bankman-Fried in 2022. Each generation believes it has invented something new, new markets, new technology, new philosophies. Each generation believes it has moved beyond the crude manipulations of the past, and each generation produces criminals who prove that the only thing that changes is the scale. The blockchain was supposed to make finance transparent. Cryptocurrency was supposed to eliminate the need for trust. And the biggest fraud of the crypto era was a trust fraud. The oldest trick in the book dressed up in a t-shirt and beanbag. But before we arrive at what all of this means, there are a few more stories you need to hear. Because the criminal history of Wall Street isn't just about the headline names. It's about a system. Let me tell you about a bank you probably use. Wells Fargo, one of the largest banks in the United States. Hundreds of billions in assets, thousands of branches, tens of millions of customers. The bank where your neighbor might have a checking account, where your parents might have a mortgage, where your local small business might have a line of credit. In 2016, regulators discovered that Wells Fargo employees had created approximately 3.5 million unauthorized bank accounts and credit cards. Accounts that the customers themselves never asked for, never agreed to, and often didn't even know about. 3.5 million. Here's how it happened. Wells Fargo's management had set extraordinarily aggressive sales targets. Employees were expected to sell customers multiple products, a checking account, and a savings account, and a credit card, and an investment product. The pressure was relentless. Some employees described expectations as high as 20 product sales per day. Former employees testified about what the sales floor was like. They described crying, vomiting, severe panic attacks. One employee said the pressure was so intense that people would come to work knowing they were going to be fired that day for not meeting targets. The choice was simple: commit fraud or lose your job. So they committed fraud. They opened accounts without permission. They signed customers up for credit cards they never requested. They created fake email addresses to enroll customers in online banking without their knowledge. Approximately 85,000 of these unauthorized accounts incurred fees. Fees that customers didn't owe for accounts they didn't want. When the scandal broke, Wells Fargo fired 5,300 employees. 5,300 people lost their jobs, not the executives who created the sales targets, but the ground-level employees who carried them out. The CEO, John Stumpf, was eventually forced to resign and surrendered $69 million in compensation. Another senior executive, Carrie Tolstead, surrendered $67 million. The Federal Reserve took the extraordinary step of imposing an asset cap on Wells Fargo, essentially limiting the bank's ability to grow until it fixed its internal controls. That cap remained in place for years. But here's the deeper point. Wells Fargo wasn't a case of a few rogue employees going off script. It was the opposite. The employees were following the script. They were doing exactly what the system incentivized them to do. The fraud was management-driven. The targets were set by leadership. The culture was created from the top down. This is what systemic fraud looks like. Not one criminal mastermind, a system designed to produce criminal outcomes. Now let me show you a different kind of systemic crime, one that didn't involve fake accounts or misleading customers, one that involved something far more sophisticated and far more difficult to detect. For more than 8 years, from 2008 to 2016, at least 15 traders on J.P. Morgan Chase's precious metals and U.S. Treasury trading desks engaged in a practice called spoofing. Here's how it worked. A trader would place a large order for gold futures. Say, an order to buy 10,000 contracts. This order would move the market. Other traders, including high-frequency trading algorithms, would see the large buy order and interpret it as a signal that prices were about to rise. They'd start buying too. But the original order was fake. The JP Morgan trader never intended to execute it. The moment the market moved in the desired direction, they'd cancel the fake order and sell their real, much smaller position at the now inflated price. The profit came from tricking other market participants into thinking there was demand that didn't exist. One trader described the technique in a chat message as a little razzle-dazzle to juke the algos. It's a form of market manipulation, and it went on for 8 years across 2 trading desks involving 15 traders. When the Department of Justice finally brought charges, they used a legal tool typically reserved for organized crime, the RICO Act, the same law used against the mafia. The same law first applied to a Wall Street figure when they went after Michael Milken in the 1980s. JP Morgan paid $920 million in penalties, the largest fine ever imposed by the Commodity Futures Trading Commission. The head of the bank's precious metals desk received a 1-year prison sentence. Another trader, described by prosecutors as the most prolific spoofer the government has ever prosecuted, received 2 years. And JP Morgan? It admitted wrongdoing, paid the fine, and continued operating. In 2024, it was fined an additional $448 million for continued surveillance failures. Now, let me give you one more story in this chapter. A brief one, but one that crystallizes the absurdity of Wall Street justice better than anything else in this video. Stephen A. Cohen ran SAC Capital Advisors, one of the most successful hedge funds in history. His returns were legendary, and as it turned out, partially built on insider trading. In 2013, SAC Capital pleaded guilty to securities fraud and paid $1.8 billion in fines. It was the largest insider trading penalty in American history at the time. Cohen himself was never criminally charged. The fund was restructured into a family office called Point 72 Asset Management. Cohen kept his fortune. And in 2020, he bought the New York Mets baseball team for $2.4 billion. Let me put those numbers next to each other. His fund paid $1.8 billion in fines for securities fraud. He then bought a baseball team for $2.4 billion. On Wall Street, fines are not punishments. They're invoices. And while we're on the subject of Wall Street justice, let me give you one final comparison. Martha Stewart sold approximately 4,000 shares of ImClone stock one day before the company announced that the FDA had rejected its new cancer drug. She was tipped off by her broker. She saved approximately $45,000 by selling early. For this, Martha Stewart was convicted of obstruction of justice and lying to federal investigators. She was sentenced to 5 months in prison and 5 months of home confinement. Martha Stewart went to prison for saving $45,000. Dick Fuld pocketed $529 million while presiding over the largest bankruptcy in American history. he was never charged with anything. I'm going to let you sit with that for a moment. There are still a few more stories to tell. Quieter ones, perhaps, but no less revealing. For every Wall Street fraud that makes headlines, there are others that slip beneath the radar. Not because they're small, but because they're overshadowed by louder, flashier crimes happening at the same time. These are the stories that remind us, for every fraud you know about, there are others hiding in the shadows. Alan Stanford ran the second largest Ponzi scheme in American history, $8 billion. For 20 years, he lured investors to buy certificates of deposit from his offshore bank in Antigua with promises of above-market returns. He styled himself Sir Alan Stanford, having obtained a knighthood from the Antiguan government. He sponsored cricket tournaments. He cultivated the image of a Caribbean gentleman financier. The entire empire was controlled by just two people, Stanford and his college roommate, James Davis. 30,000 clients in 131 countries, $8.5 billion in purported assets. All of it a lie. In 2012, Stanford was convicted on 13 of 14 counts. His sentence, 110 years in federal prison. His earliest possible release date is March 13th, 2103. He's currently 75 years old. For years after his conviction, his victims recovered practically nothing. It wasn't until 2023 that a settlement with TD Bank and other financial institutions began returning money, $1.6 billion, a fraction of what was stolen. Stanford's crime was almost identical to Madoff's. Same structure, same promises, same inevitable collapse. But because Madoff was bigger, Stanford was forgotten. The second largest Ponzi scheme in history is a footnote. Then there's Wirecard. If Enron was America's defining corporate fraud, Wirecard was Europe's. A German payment processing company that rose to the prestigious DAX 30, Germany's equivalent of the Dow Jones. At its peak, Wirecard was worth more than 24 billion euros. In June 2020, the company revealed that 1.9 billion euros supposedly held in trust accounts in the Philippines simply didn't exist. The money wasn't there. Had never been there. The accounts were fictional. CEO Marcus Braun was arrested, but the more dramatic figure was the company's chief operating officer, Jan Marsalek. When investigators closed in, Marsalek vanished. He boarded a private plane and disappeared. As of 2026, he remains one of Europol's most wanted fugitives. He's believed to be living under protection in Russia, though his exact whereabouts remain unknown. What makes Wirecard particularly disturbing isn't just the fraud itself. It's what happened to the people who tried to expose it. The Financial Times ran investigative articles questioning Wirecard's numbers as early as 2015. In response, Wirecard didn't just deny the allegations, it sued the journalists. And Germany's financial regulator, BaFin, didn't investigate Wirecard. It investigated the journalists and the short sellers who were betting against the company. The watchdog attacked the watchdogs. The regulator protected the criminal. It was the Markopoulos story all over again. Only this time, instead of simply ignoring the whistleblower, the system actively punished those who dared to speak up. And finally, a quick story about the London whale. In 2012, a trader at JP Morgan Chase named Bruno Ixel accumulated such massive positions in credit default swaps that other traders in the market began calling him the London Whale. His positions were so large, they were distorting the entire market. JP Morgan's chief investment office, which was supposed to be a conservative risk management unit, had, under ICSIL's watch, become a speculative trading desk. When the trades started going wrong, the losses snowballed. The initial reported loss was $2 billion. The final number was $6.2 billion. And one of the contributing factors, a copy-paste error in an Excel spreadsheet. The error affected a risk model that was supposed to measure how much the bank stood to lose. The flawed model essentially halved the estimated risk, which emboldened the traders to make even bigger bets. A spreadsheet mistake helped trigger one of the largest trading losses in banking history. When the story first broke, JP Morgan CEO Jamie Dimon dismissed it as a tempest in a teapot. 2 months later, the losses had tripled. JP Morgan paid $920 million in fines, but neither ICSIL nor any senior manager faced criminal charges. These are the quiet ones, the ones that didn't make the movie, the ones that didn't get the Netflix documentary, but they're part of the same story, the same pattern, the same system. So here we are, 160 years, 32 stories, hundreds of billions of dollars stolen, millions of lives disrupted, careers destroyed, retirement savings evaporated, banks collapsed, companies dissolved. An entire global economy brought to its knees. And what have we learned? Let me tell you what I see. I see the same pattern, repeating over and over and over again. Different names, different eras, different technologies, but the same fundamental dynamics. Every single time, someone discovers they can take other people's money and get away with it. They start small. They get bolder. The system, the regulators, the auditors, the boards of directors either doesn't notice, doesn't care, or is actively complicit. Someone sounds the alarm. They're ignored, or fired, or investigated. The scheme grows until it can't sustain itself anymore. It collapses. There's outrage. New laws are passed. Everyone says never again. And then it happens again. Jay Gould tried to corner the gold market in 1869. They created the SEC. Michael Milken raided the bond market in the 1980s. They passed FIRREA. Enron and WorldCom lied about everything in the early 2000s. They passed Sarbanes-Oxley. The banks crashed the global economy in 2008. They passed Dodd-Frank. And then FTX stole $8 billion in 2022. Each generation believes it has finally solved the problem. Each generation is wrong. The belief that we've fixed it is the vulnerability. But here's the thing that haunts me most. It's not the size of the numbers. It's not the audacity of the criminals. It's the punishment gap. Martha Stewart went to prison for saving $45,000. Jordan Belfort stole $200 million, served 22 months, and now earns millions as a motivational speaker. Dick Gould presided over the largest bankruptcy in American history, pocketed $529 million, and was never charged with a crime. Stephen Cohen's fund paid $1.8 billion in fraud penalties, and he bought a baseball team. The system doesn't punish Wall Street crime. It prices it. Fines are a line item. Prison is for the unlucky few. The real consequence of committing financial fraud on a massive scale is a consulting firm, a speaking tour, a sports franchise, and perhaps the darkest pattern of all, the whistleblowers. Harry Markopoulos spent 8 years telling the SEC that Madoff was a fraud. They ignored him. Cynthia Cooper risked her career to expose WorldCom's lies. Matthew Lee raised the alarm about Lehman's Repo 105. He was ignored. The Financial Times spent years exposing Wirecard. The regulator investigated the reporters, not the company. The system doesn't just fail to detect fraud, it punishes the people who do. Now, I'm not telling you this to make you cynical, and I'm not telling you this because I think the entire financial system is irredeemably corrupt. I'm telling you this because the patterns are real, because understanding them is the first step toward not being a victim of them. And because the history of Wall Street crime is ultimately a history of human nature. Greed doesn't evolve. Technology changes. Regulations expand. Markets get more sophisticated. But the fundamental mechanics of fraud have remained constant for 160 years. Take other people's money, lie about what you're doing with it, and hope nobody checks. The question is never whether there's another Madoff out there right now. The question is, who? Sleep well, midnight magnates, but sleep knowing. Since you made it this far, I'm glad you enjoyed the episode. If you would like to continue listening to episodes with similar themes, I linked them in the description below. You will also find a playlist of our most popular videos. Sleep now, midnight magnates, and wake up, as always, a little stronger and a little wiser. The story is done, but yours continues.